Let's bring in Wilmington Trust Meghan Shue. Meghan, good to talk to you. It seems as though investors are just really shrugging off any impact from the government shutdown here.
Yeah, Contessa, I think that's right. And it jives with what we've seen historically. Historically, shutdowns don't have a material economic impact, especially if they stay short enough in duration. You tend to get basically a tenth to 2/10 per week for every week that the government shut down, but then you get that made back up for the most part once the government reopens. And the last few shutdowns, we've seen the S&P 500 flat to up, even for some of the longer ones. And I think that the sort of the caveats today are that we are riding a very strong wave of momentum with valuations getting a little bit stretched. So could this be enough of a catalyst if it goes on long enough to see investors take some profits? And then the labor market as well. Not only do we have less visibility with less government data, but if you see some of those furloughs turn into layoffs, that could be enough to take an already soft labor market over the edge.
And yet you really like consumer discretionary, which, you know, when you're looking at the job market tightening, sometimes people feel pinched even if they still have their own jobs.
Right. And the labor market has been super interesting to follow right now. We are seeing a real slowdown in job demand, but also not really any material pickup in layoffs. So it's a bit of a stagnating job market. And I think the consumer discretionary sector, it's important to remember, it's a very differentiated sector with a lot of different opportunities within there. And when we look at the consumer overall, I would say that it's that bottom quintile that is probably the most stretched when it comes to cash and debt levels. But the rest of the consumer cohort still looks pretty much okay. And that's why we're still seeing some opportunities in consumer discretionary.